Thanks for joining in today at CMD, your CPA and trusted advisor. Today, our topic is going to be talking about tax law changes that have recently occurred as a result of the Tax Cut and Jobs Act. We're going to talk about the tax bracket changes, changes to your itemized deductions, the Affordable Care Act, and we're going to spend a little time talking about the new deduction for small businesses for pass-through entities. So primarily the changes that have happened are effective after December 31st, 17. So pretty much this tax return you're about to file, all of this stuff is going to be relevant for this tax return you're filing now for the 2018 tax year. One point to note is that all of these changes, most of these changes that we're going to talk about, do what's called sunset after 2025. So that means these are temporary. So if the government doesn't extend these tax programs that are in here, or make them permanent for that matter, 2025 they're going to go away, and it's going to revert back to what happened or what 2017 looked like as far as everything that I'm going to show you, with few exceptions. One more thing to note is that so once the regulation, or not the regulation, once the tax law changed, the IRS is now in process of issuing interpretive guidance and regulations of how you should apply and what the Congress really meant when they wrote the tax code, right? So, and there's guidance that's coming out as recent as, really as recent as last week. Yeah, I think Monday they published some stuff. Actually, the small business deduction, they just came out with some stuff on there, and it's been flip-flopping, right? So, at one point, for example, realtors were considered a service-based business. Well, then they came out with the proposed guidance and said they weren't. And they said, nah, they are. And then they came back on last Monday, and said, nope, you're not a service-based business anymore. So you're in the clear with one of the rules that's out there. Last thing, does anybody here operate in another state as well? Yeah, a couple. So one of the things just to know is that the changes here are at the federal level. Most states, in the past, they would just conform to what the IRS rules were. So if the IRS effectively, with few exceptions, said something was deductible or not deductible, the states would just kind of acquiesce to that, and your process, the numbers would be different, but the concepts would be the same. Well, now, because of the state rule, or because of the rules that have changed, not all states have acquiesced to that, right? So as an example, one of the things that I'm going to show you here in a second is that if you were an employee, your unreimbursed business expenses that used to be there that you could deduct if you were itemizing, you can't deduct at a federal level anymore. But certain states are saying, yeah, but you could still deduct it with us, right? And some states actually haven't even come out and decided yet. So from a state level, if you're outside of one of the few states that have no state income tax, like here, then you need to make sure you're paying attention to that, or you're working with somebody that's on top of that for whatever state that you're doing business in.
So say my LLC has my payroll coming, my check's going to that LLC from Colorado and from here. There's state tax there, but there's no state tax here. So
yeah. So what's going to happen?
Formed here, do I still not pay?
Yeah. So there's going to be two kind of components to it. So one is whether or not the state has a business income tax, which I'm not sure off the top of my head if Colorado does. Not all states do. But when you file your personal taxes is where it's going to be impactful, because you're going to file your personal taxes as either a non-resident, a part-year resident, or maybe you formerly live there and you spend time here as a full-year resident. And so based on that, when you file your Colorado state tax return at your personal level is where this will impact you.
Okay.
Yeah. So general changes we're going to go through, starting with some of the individual stuff. So as you can see up here, the tax brackets have changed. So okay, it's working this screen. So up here you've got the 2017 tax brackets, and then below that you've got the new law, so 2018 through 2025. You can see that they kind of both start at 10%, and then there's some changes here where there's a new 12 and 22 and 24% bracket, and it goes up to only 37% now, whereas in the past it was going up to 39.6%. So that's a change that's there.
What is the 12 and 15? What is that for?
So it's when you pay your income taxes. The U.S. tax bracket is a progressive tax system, so you pay tax at rates based on income levels going up. So for example, I don't have them all memorized, but for the first $10,000 you paid 10% tax, so that's $1,000. But let's say you made $15,000 this year. Well, for that next $5,000, you're going to pay tax on that $5,000 at 12%. And so then so on and so forth, and it just keeps going. Your income is
put into each one of these different brackets and taxed at different levels to determine your overall tax liability.
So
Yeah, we need the list actually with the income.
Sure. Yeah, I don't have that up there.
Yeah,
You
it
can you
doesn't
can
make
easily
sense.
find that online, right? Or if you send me an email, I'll tell you where you can find it. Right? Yeah. So how many people here have dependents that they claim, children? Yeah. So you used to be able to get a $4,000 deduction. Now you get nothing. So one of the things that have went away from that. Now, on the flip side to that, one of the benefits that they gave you is if those dependents are children, they've doubled the tax credit. So whereas in the past you'd only get a $1,000 tax credit, this year when you do your 2018 taxes, you can get up to a $2,000 tax credit.
But
They've
children
also
is up to the age of what?
up to the I believe this credit is up to 17 or through 17. I believe is where this credit goes to.
So if it's a student child that lives with you, it's
Yeah.
nothing now.
For that, correct.
For that.
Yeah. But they've also doubled the, I think it's almost doubled the phase-out thresholds. So whereas before, I think if the number was somewhere around $150,000 to $200,000 as married, if you were in that income threshold, you were no longer getting this credit. They doubled that to somewhere around $350,000 to $400,000. So more people are now eligible for this credit to offset the loss of that $4,000 deduction. Right? Credits are better than deductions because credits are dollar for dollar savings, whereas deductions are savings only at your tax bracket. So it's just a percentage of that number. Another thing that they did, which is very impactful to most people, is they've doubled the standard deductions. So when you would do your taxes, you would either have a standard deduction or you could itemize your deductions, right? So in the past, so if you were married, you had about a $12,700 deduction in 2017. In 2018, you now have a $24,000 tax deduction. So with that, does anybody here know what, especially at least in Nevada, what the top two things that people would itemize on their deductions if they were itemizing?
gas.
Mortgage interest.
Mortgage interest, yep, that's number one. And number two? Nope, still goes along with real estate. Property taxes. So property taxes and interest are the two largest itemized deductions that most people will take in the state of Nevada where there's no income tax. So if you were to take a look at your mortgage interest statement and your property taxes, in order for you to really, in Nevada, because of low property taxes and low cost of homes in general, in order for you to be able to itemize, you actually need to have at least about a $400,000 note that's outstanding, right? So if you have less than that, high likelihood that you guys are going to be taking the standard deduction this year. I bring that up just to make you guys aware, especially the realtors in the room.
I'll just take a picture of this because I
Yeah,
can't
sure,
see it from
sure, go for it. You send me an email and I'll send it to you. All right, so
I'm sorry, you said it was property tax and what?
and mortgage interest. Mortgage interest. So one of the things for the realtors in the room just to think about, a lot of people think, well, I'm going to buy a house because I'm going to have a tax benefit too, right? So just from a tax standpoint, it makes sense for me to buy instead of renting. Well, that's not true anymore, right? Now, unless you're getting up into the higher echelons of homes in Nevada, you may not be getting that same benefit like you would elsewhere.
So do you not get anything?
So you kind of line up all of your itemized deductions. So you take your mortgage interest, you take your property taxes. In Nevada, you would take the sales tax deduction because there's no income tax. Those are the primary ones that you're going to be taking out here, and compare that number to these standard deduction numbers. So if those numbers, if you're married and those numbers don't exceed $24,000, you're just going to get a $24,000 tax deduction. So what that means, if you're single, it's $12,000. So if you're single, there's a higher likelihood that you're going to be itemizing. The government is projecting about 90% of the people in the U.S. will take the standard deduction for 2018 as a result of that. And so just the tax incentive to purchase a home has gone down. There's other incentives, obviously, right, to be a homeowner, but the tax incentive has gone away. So I know I'm sure the realtors here aren't CPAs, and so you're not giving your clients tax advice to begin with, but just know in the back of your mind, either avoid the topic or don't bring up that it's a tax benefit, right, for them to have a home anymore. And again, that's Nevada, right? There's other places where there could still be benefits, right, where there's high mortgages or much higher property taxes. couple other things that are in here that are relevant to you guys. With the mortgage interest side, it's also capped at mortgage interest for an original loan balance of $750,000. So you can only deduct your mortgage interest, presuming that being the balance. If it's over that, your deduction is limited to that $750,000 thing. Another one that's very relevant is home equity interest, right? So in the past, it was much more liberal, where, you know, if you had a home equity loan, you could pay off your credit cards, you know, or you could buy a car, and you're able to write off that interest, right, in the past. Going forward, you can't do that anymore. So you can only deduct your home equity interest if you're using that money to improve the home that the equity line is secured. So you can't even use it to improve a second home, right? Or to go out and buy a new home. That interest is not deductible. It's only deductible now if it's improving your existing home that equity line is secured against. So that's a big change. And if you already have an home equity line, you're not grandfathered in, right? So that means you now have to go and prove, in order to take the interest expense deduction, that whatever you spent that money on was to improve that home and nothing else. So you're going to have to go back and find documents if you're not good at saving documents to begin with, or you just won't be able to take that deduction. Now again, 90% of people aren't itemizing anyway, so it's probably not going to impact 90% of the people, right? But for those people that it is going to impact, it's going to be a little bit more challenging than it was in the past. State and local tax issues. So primarily I'm just going to be talking to the people watching online here about this one, because it's not really going to impact you in Nevada. So in Nevada, there's no income tax, right? So you don't have that. And property taxes are relatively low. So the majority, I'd say 99% of Nevadans aren't going to max out this $10,000 threshold. Whereas just about anybody that lives in New York is going to max out this threshold, right? And so what happens now is the state and local taxes used to be fully deducted. Now it's capped at $10,000. So this includes income taxes. So if you're in a high tax place like New York or in California, you're pretty ticked off right now. In fact, so much so that some of those states, I believe New York is one of them, New York, New Jersey, they're actually suing the federal government, saying that the changes to the tax law weren't fair and equitable to everybody. That hasn't been resolved as far as I'm aware yet, but just kind of know in the states that are out there that are high tax, you guys are getting hit pretty hard by this state and local tax limitation. An exception to that is rental properties. So if you have a rental property, both that mortgage interest limitation and this property tax limitation do not apply, right? So you'd have 100 rental properties and you're paying $1 million in property taxes, right? That's not going to impact you for this law. This is only impacting you for your primary residence when you're itemizing your personal deductions. Yeah.
For the state of Nevada, though, like I have clients that live in LA and they own several rental properties. They got a letter in the mail regarding that. Their taxes are going to go up. Their property taxes are going to go up.
That's possible. Yeah, so as home values go up, depending on where they're at, right, your property taxes go up because it's usually a percentage of the assessed value. Okay. But that's not dealing with the deduction.
Okay.
Yeah.
Okay.
Yep.
Yeah, I'll ask you later.
Okay, yeah, perfect. So another thing on here, so for, this is kind of what I was talking about, the unreimbursed business expenses, right? So these are a few things that you used to be able to deduct that you can't deduct anymore. So if maybe your spouse was using one of the Form 2106s, so the unreimbursed business expenses, that goes away. So you don't get a deduction anymore. So it's more in favor of being a small business owner nowadays than being an employee. And so this will certainly impact some people that are employees that tend to take that extra deduction. A note on here, so a couple things that, remember, this is specific to being a personal, not to the business. So, you know, like where I put tax preparation fees, that used to be deductible on the personal level, subject to this threshold. Now it's not, but still from a business standpoint, right? If you have business things that are being done, that's still definitely deductible for you. Last thing here, kind of on the personal side, the Affordable Care Act, so Obamacare. So there were some penalties, right, if you didn't have health insurance. Those penalties are still in effect for 2018. So if you didn't have health insurance in 2018, you are still subject to these potential penalties that are up here. Starting January 1, 2019, Obamacare, and this rule specifically, has been repealed. So while you may need health insurance, right, for other reasons, you don't need them for your taxes. So now flipping over to the businesses. So a couple things on the business changes that are out there. So first off, if you were a business, entertainment expenses used to be deductible. You used to be able to take a 50% deduction. So if you're going to take somebody out to a Golden Knights game out here, right, and you're entertaining your client, you used to be able to deduct 50% of the cost of those tickets. Now you can deduct none of the cost of those tickets. So that's gone. So all entertainment expenses have been wiped away. Now, on the flip side, if there's meals, right, that you're having, so you're taking, a client or a business partner or whoever for a business reason to lunch or to dinner or something like that, that's still deductible at 50%. So no change on that. It's been 50%. You can still deduct the same 50% on that. Yeah.
How about traveling for business?
Yeah, so traveling for business, what you're able to deduct with travel is the cost of your meals. The difference is when you're not traveling, the requirement is that you're with a client, a prospective client, right? Or coworkers, right? You're doing something that's growing your business with somebody at that time. That's why you're able to take that deduction. Whereas with travel, you don't have to be with somebody because you're out meeting with people or doing things to deduct the travel meals. That's why you may see in accounting softwares, they have two separate categories. They roll into the same spot, they just have different requirements, so you may want to just separate them. That's why people do that.
So,
yeah.
I'm sorry, how are you gonna prove that you were with a client? How are you gonna prove that?
Yeah, so I would, it's difficult, right, to prove that. So obviously, one, you want to have the receipt, right? Helps if you have the receipt, it shows there's multiple people. Now let's say you're there with your spouse and your spouse isn't a client, how's the IRS gonna know? Right? I mean, I don't know, but the burden of proof is on you, not them, right? So if it seems like, so if every day you go out and you say you have a meal with a client and you've got $1,000 of business income, the IRS is gonna say, what the heck are you doing, right? Are you really running a business, right? So there's different thresholds, right? There's analytics, right? I come from an audit background, so there's different ways that I would look at things on my end to try to prove that without necessarily having the source documents. But yeah, at the end of the day, it's on you, right? So, it'd be helpful to have calendar appointments, right? Where you have somebody who's accepted that calendar appointment, right? I don't know that you're ever gonna need that level of threshold. The more aggressive you are on deducting things, the more support you wanna make sure you have, right? But for example, I just bought all this food here for everybody, right? How do they know anybody showed up, right? Well, I have a video, they can hear people talking, right? There's things, but are they gonna ask me that, for a couple $100 of food, right? Probably not. But if I deducted, $250 of food for, 365 days a year, and I only had one client, they'd probably ask me some more questions, right? So it becomes kind of a reasonable assessment.
Is this separate from your standardized deduction, or if you're does that matter? This stuff matter?
We're now in a totally different ballgame.
So
right?
you
I'm
can
sorry I
have
didn't
your
make that clear.
standardized 12
Yeah.
grand, and then
Yeah,
these
so,
expenses as well.
so what I talked about from before this slide, so really from this slide earlier when we started talking about taxes, is the individual side.
Okay.
Now from this slide over, we're talking about the business side.
Okay, I
So
just wanted
the
to-
limitations and deductions, whether you're itemizing or not, doesn't impact this
Okay.
because you're going to be filling out your business taxes with this information,
Gotcha. Okay.
which will either be on your Schedule C if you're kind of passed through as a single member LLC, or it'll be on a corporate form or a partnership tax return or something like that. Okay. So now we get into, this is the biggest change that's out there, and I'm going to spend the shortest amount of time on it. The reason why I'm going to spend the shortest amount of time on it is because it's so complex. I've sat in a training for over a day just going through some of the complexities of that, and it doesn't matter how long I spend here on this trying to go through all the ins and outs, it's just confusing. So I'm just going to give you the nickel tour of it, so you kind of have a high level idea. So this is a new deduction, right? So in 2017 earlier it didn't apply. This applies now starting in 2018. What the government is giving you is for your businesses, for pass-through businesses. So pretty much not a C corporation, but the other types of business entities we've talked about, right? So partnerships, S corporations, single member LLCs. Those businesses will get a 20% deduction on their taxes this year when they file on their personal taxes. There's a new line on there for qualified business income. So what you'll do is basically you take your profit, so whatever your profit is. So in my example earlier, our profit was $100,000. So if that's your profit, barring plus or minus a few other different things, you'll get a $20,000 deduction on your taxes. But now remember what I was saying.
The total amount that you made, or
The total
net?
The total profit. So the net.
The net.
So you take your income, so if you're a realtor, right, your gross commissions, all of your different expenses, the bottom number. So in my example, I'm calling that bottom number $100,000.
Okay.
So maybe your gross commissions were 150.
Right.
Right? So $100,000, you get a $20,000 reduction. Now, if you were the S corp that we talked about, and you're taking a payroll, so now you have your $70,000 payroll wage, you're only going to have $30,000 passing through. So now you're only going to get a $6,000 reduction, right? So that's one of the reasons, again, that single member LLC is better to be taxed as a sole proprietor than an S corporation. Now, there's a whole lot of changes that are in there if you're a service-based business versus not a service-based business.
And you're saying real estate is considered not? a
Real
service?
estate is no longer considered a service-based business. You were on the fence for a couple of months, but now you're no longer in the service industry according to the IRS. I am, so.
What about business consulting, is that still service?
That is definitely still service, yeah, yeah. So it's basically if the image or likeness of somebody is really what's driving the business, and it's that skill that's doing it, that's where they're calling it a service-based business. So CPAs, attorneys, doctors, consultants, those types of things are all considered service. And then there's some exceptions where sounding like a realtor would be, but the National Association of Realtors is a very strong lobby. You know, there's millions of realtors out there, right? So they actually got excluded from it, right? So they did a good job. So if you pay
So
that
which
extra
category?
$20 to the Political Action Committee when you renew your license out here, that's your money at work. So
So which category are we in now?
as a
Sales,
realtor,
right?
Yeah.
as a realtor, you're not a service-based business.
But what are we, sales?
Which?
No, you're a realtor. It's just, there's just a question on the tax form now that says, "Are you a service-based business?"
Oh,
And so
sales.
you just would be no.
Okay.
Whereas
Why
you
can't
would
we
be.
say real estate consultant? That would be in the service business then.
Don't say that then, right? You don't want to hurt yourself, right? So there's thresholds, right? So that impact you here. So under $157,500, if you're under that single or under $315,000 married, you don't have to worry too much about it, right? You only have to worry about it if you're over those thresholds. So if you're a service-based business and you're over those thresholds, no deduction. Doesn't matter if you're $1 over those, no deductions. If you're not a service-based business, that's where the incredible calculation comes in where if you're not a service-based business, don't do your taxes. Have somebody else file them, don't do them yourself. Let me clarify that. Do your taxes, just don't file them yourself. Hire someone to file them. It's incredibly complicated when you get
That's all for 2000, is that all for 2018 you're talking about, or 19?
Starts in 18 and goes right now through 2025.
Well, that's it for today. Thanks for joining in. Make sure to subscribe to our YouTube channel so you can stay up to date on all of the videos that we post. In addition, you can find our contact information here. If you have any questions, please feel free and reach out. Thanks, and we'll see you next time.